When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the wrong money question to ask after Trump's second presidency. Also, 10 ways to generate income in retirement. We'll answer some listener questions for you. Also, some things that you'll spend more on in retirement. My name is Jeff Shea, and as always, I'm just here to ask the questions. But of course, the words of wisdom and solid advice, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing this fine January morning?
I am doing great. How are you?
I'm doing great. Thank you. Excited to be with you. President is going to take office here for the second time in just about 2 days or so. There's a lot of optimism surrounding the Trump presidency 2.0. I predict, what do you think, Jeff, is that within the first weeks, he's going to be pretty busy with that pen. What do you think?
Yeah, he says he's going to. I think I heard either him say or somebody said that he's quoted 100 executive orders going into play the day he takes office. And,
right.
I think that's a lot more than the 50 or 60 that Biden did for his first day or two. But, he's done so many more. And right now, the last few weeks, he's done everything he can to sabotage the president coming in, overspending, forgiving student debt, doing all these things that are, in my opinion, unconstitutional and need ratification through, Congress. But he's doing it anyway, and he's going to make it difficult for Trump. He's a sourpuss loser and doesn't like the idea that they kind of booted him out. And so he's taking it out on Trump in the next presidency. And Kamala Harris isn't very happy either. I don't think Kamala and Biden get along very good anymore, but they both have one same common mission, and that is to screw Trump over because he beat them both. So, well, he didn't, I guess technically he didn't beat Biden. Biden, if you call it a win, may have beat him depending on the real results of an election where he never came out of a basement and somehow won. But, this last one with Kamala Harris, that was a very decisive win, very decisive mandate. We want Trump. We want his policies. We want the things that he does for America back. We want him to be the leader in charge of getting our economy back, basically righting the ship and getting us energy independent and lowering the cost of so many things that have gone up out of control. The biggest thing is energy. And if we talk about the biggest effect on inflation is a transportation cost. I read somewhere that the cost of food in the grocery store, 60% of it isn't the food itself, it's the transportation to get it there. So if transportation doubles, you've got food going up 40, 50%, right? So if we can get energy independence back, I think that's probably one of the biggest keys to getting us, basically back on our feet. A lot of other things too, the different types of energy, allowing drilling off the Gulf of America. If they change the name from Gulf of Mexico to Gulf of America, those mandates that Biden just put in, by the way, just recently, basically banning drilling in the Gulf of Mexico. He didn't do it while he was in charge. He just banned drilling in Alaska and other places, but now he's going to ban it in drilling in Gulf of Mexico where, really? So why would he do that? Well, the only reason he would do that is just to basically give the finger to Trump when he comes into office. But he can undo it. He can either undo it with congressional approval, and I think he'll get that if he goes that route, or he can just change the name of the Gulf of Mexico to Gulf of America, and then he's not drilling in the Gulf of Mexico anymore, right? So I think he's got a lot of ways. I would rather have Donald Trump in between me and our country's enemies than Biden or Harris or anybody the Democrats have put out there in front of me for a long time, including Obama, who at least talked a bigger game but didn't do much. But consider that there's been more wars and fighting around the world going on with those people in power than it was with Trump. So I think the world will be a safer place. I can't believe the garbage that Biden's trying to say he left a legacy and did so much for America and the world's a safer place. And, the people around him say the same things. They're like, who believes that? I mean, do people really believe that? I guess people that are just true blue dyed-in-the-wool Democrats that don't have a brain or look past, verbiage off of a TV screen must be able to believe that. But if you think about what's really happening and you just count the number of, stupid things that have gone on, I just can't understand how, he can be proud of the legacy he's left, but, trying to pump his name up and do the best he can calling himself a legendary president and all that kind of stuff when, there's only one guy that was voted lower than him in our lifetimes. That was Nixon. And it's not even in most people's lifetimes. It is in yours and mine barely. But, most people don't even know who Nixon was. So in the lifetimes of the average American today, nobody's known a worse president or one with at least or a lower approval rating. I don't know. He did more to screw everything up. In fact, I just, read, still the true inflation report. If you look at the true inflation, it's up, 27% since he took office in 2021. So, if you look at the real inflation, people are spending, if you made $100,000 a year before, you've got to make about $135,000 because, minus taxes, you've got to have some left to spend. Most people aren't able to do that. How are you able to do better when that inflation comes in so hot? Now, interesting thing too, speaking of inflation, I know I'm getting kind of off track here, but we've got a new president coming, on board, and he's going to do a lot of things to lower inflation. Speaking of inflation, last week we got the numbers on Tuesday that the inflation is up 3.3%, and they expected 3.4%. Well, what happened to the mandate that we need inflation down to 2%? I mean, we were actually in the 2 range 6-8 months ago, and it was all of a sudden time, we're almost at 2. We're at 2.6, 2.8. Well, we're not at 2, but it's really getting better. So since it's getting so much better, let's just start lowering interest rates again. Well, so what did the Fed do? They lowered short-term interest rates so they can pay less on a short-term debt. But the bond market went crazy and sold off. In the last 6 months, we've lost 10 or 15% in the long-term bonds. Interest rates have gone from below 4% to now they're pushing 5% on anything longer than a 10-year yield. So what has that done? That's because it's naturally fighting the inflationary pressures that the Fed keeps doing by lowering interest rates, basically printing money, giving it to the banks to, do their business, buy their own stock and manipulate Wall Street in their benefit, where the Fed or the central bank was created supposedly with under the understanding that it was to help stabilize the market so the consumer would be protected. But it's not that. It's never been that. Who are the partners? The partners aren't the people. The partners of the Fed are the biggest 7 banks. I mean, the biggest banks on the planet are the ones directing, what they do. So it's been manipulated. Inflationary forces have been kicked into high gear. The bond market is trying to mitigate it by raising interest rates because the bondholders are selling off. It's doing, a fair job considering, with all the money that's been printed in the trillions of dollars that's essentially been printed while they're supposedly quantitative tightening, taking money out of the market. I think they've taken less than $1 trillion out of the market by, selling bonds and taking the money out, but they've been backdooring that money back into the banking system, I think to the tune of somewhere between $2 and $4 trillion, depending on what numbers you use and what, reporting agency you read. So, they really haven't done anything to curb inflation. It's going to continue to ramp up. I hope Trump can get that under control fast because that's really going to be the biggest thing to save America, energy independence. And we've already seen some of the effects of what people think will happen when Trump gets in office. In reality, energy stocks should be doing worse if the price of energy goes down. But there's a lot of things like energy infrastructure. The fact is we'll be producing more energy. Those companies, especially local, domestic companies, USA-based companies, will probably have a better chance of making more money just based on the fact that they'll be able to access our own energy here. But back to the inflation numbers, 3.4% is higher than 2%, a lot higher. It's higher than 2.4 or 2.5, which we were seeing just within a year ago. Yet somehow it's okay to keep lowering interest rates and say, well, maybe not so fast, but we're still going to keep a very dovish perspective on interest rates, and we're going to accommodate the markets because we've dug ourselves such a big problem with debt that we need to artificially lower interest rates. And, well, who cares if it hurts the American people? They can't pay their bills. There's record defaults on mortgages, record defaults on credit cards, record defaults, higher than it was even in the 2008 credit crisis. So, we've got a cycle that's completing right now. We have some things that are probably going to shake out during the early days of Trump's presidency, unfortunately, that's going to make the other party probably, scream from the rooftops how bad he looks because it happened on his watch. But it's all been manipulated so that they can dump it in his lap. The good thing is he's a businessman who I think can dig out from under the pile of debris that they dump on his head and hopefully get us back in charge again. I can't wait till next week when we have a meeting after the inauguration and just see, what those executive orders start looking like and what the sentiment of the market is. It might be just a turning point when, all the anticipation already ran the market up. Of course, we had the Trump bump. We had that kind of fizzle out. December was actually one of the worst Decembers ever. Didn't have any Santa Claus rally because I think it was overdone and people realized that the market's overpriced. We still don't know what's going to happen when Trump comes in office. But we're going to see. And I look forward to, the next few shows.
We're talking with Jeff Hogan of Premier Retirement Planning, Wealth Management here in Tucson and Mesa. We're talking about the Trump Presidency 2.0 and the wrong money question to ask after Trump's election. And that money question is, what should I do with my money now that Trump is going to be president again? And I think it's an understandable question, especially given the president-elect's stated intention to implement radically different economic policies from his predecessor. However, I think that it is a short-sighted question. And what I mean by that, Jeff, is they're asking the question, what should I do with my money, or what should I do with my investments for the next 4 years? I mean, when you're doing financial planning, Trump is certainly going to have an effect here for the next 4 years. But really, we've got to look out not 4 years, but 8 years, 16 years, maybe even as long as 30 years. We do not have a crystal ball. We think we know what's going to happen here for 4 years, but we don't know what's going to happen after that. So how would you answer that question? What should I do with my money now that Trump is going to be president now for the next 4 years?
Well, honestly, I'm a little bit tentative. The fact is just like I read in the last, our opening segment is that quote that basically we know the market's going to do what it does. We just can't time it. The market's still going to do what it does. The cycles are still completing. The cycles will probably be allowed to complete under Trump because he's more of a natural economist. I think he's going to want to manipulate it a little bit too because he doesn't want it to make him look bad. I get that. But the fact is remember, I was always talking, for the last 2 years up until just a few months ago about how the yield curve inversion always results in a recession. Always. It just has. And there's only been one time that it went as long as 24 months. It's typically between like 11 and 15 months was kind of the average time that the yield curve, where the long-term yield would be lower than the short-term yield. When we had 5% short-term interest rates and only 3% long-term interest rates, that's kind of a weird situation. Normally, we're willing to take, the time horizon is kind of a risk element that we've got to wait 30 years to make sure that this bond pays off at 5%. Well, that's usually what it is, 5% on the long-term rate, 3% on the short-term rate. It was the exact flipped opposite. Well, after the June of last year, which is like month 24, I believe, maybe it was July, where we'd already exceeded the time frame for that yield curve inversion to happen, is everybody kind of stopped talking about it. In fact, me included, it was like, okay, well, they manipulated us through the yield curve inversion, the timing that normally happens. But guess what? The yield curve inverted. Now it's staying uninverted. It's uninverted. We've got long-term interest rates. We've got short-term interest rates going below, in the mid to low fours. We've got long-term interest rates, 10 years, 20 years, 30 years, going higher and pushing 5%. And it doesn't look like there's any return to that other yield curve inversion. We got to where we kind of tapped, just kind of knocked at the door and kind of for a minute flipped the inversion, but it flipped right back and it never really stuck. But with all the massive selling going on in the bond market, raising long-term interest rates, this is the longer-term interest rates, the more certain we are that yield curve inverted. Now, interesting two things that have happened. Remember, the yield curve started uninverting in November, which is, about the time the Fed finally started deciding, okay, we're going to actually have some interest rate decreases, right? I mean, just a few months ago, was it September, October, and December, something like that, but we only had some small ones. So we had a total of 100 basis points in reduction in interest rates. Well, it only affected the short-term bonds. Interesting. This is another anomaly that happened the first time ever in history, is that the Fed lowered interest rates by 100 basis points, which is 1%, between a 0.5% and 225 basis point interest rate decreases. At the same time, the bond yields actually increased 100 basis points, the long-term bonds. That's an anomaly that's never happened before. So the market's definitely broken. It's when that stuff happens, we know it's being manipulated. The thing is we can't stop it from uninverting now because the power of all the sellers in the bond market, mostly smart money, smart money, knowing that the interest rates are going, need to go up to combat inflation, that inflation really isn't getting under control, we're seeing the bond market sell off. So the market's doing what it's supposed to do. It'll probably continue to do what it's supposed to do. Now, two things I was mentioning about this recession. The recession seems to always happen within a few months of the actual yield curve re-inversion or uninversion. The other thing is it also always happens after the first or second rate cut. I think it's after 2 rate cuts. So we've had 3 now. So now basically some of the major fundamental things that precede every historical recession that we've had have just happened. Now, can Donald Trump come in and save it? I hope so. Will he? I hope so. Will the market overpower him? The market's bigger than Donald Trump, I hate to say, and so it may. So I still want to be cautious as we move forward. How do you want to invest your money? I think we're going to see just by his executive orders, they're going to kind of direct us to know what we're going to do. He might say Bitcoin's outlawed and we've got new Trump coin. If that's the case, then we need to sell Bitcoin and buy Trump coin. I don't know what's going to happen. I mean, I'm saying that kind of as a what would I say, a flippant comment. But, we also don't know what he's going to do with, how he's going to attack the energy independence. Maybe he's going to, open up all kinds of opportunities for nuclear energy more than is in existence now. Maybe those stocks go crazy. I think anything involved with energy long term is probably going to be better because Trump is president for the next 4 years, especially local companies. But that doesn't mean throw all your money at anything that has to do with energy. I mean, there's some ETFs, exchange traded funds that deal with energy that seem to kind of as a whole, because it's based on that segment of the market. Maybe nice and slow and steady way to play that game. I don't know that I'd be interested in picking, penny stocks that have high futures unless you've got some risk money that you can afford to lose. But bottom line is there's going to be some opportunities, down the road. There's going to be also some things that might be negative. If the tariffs that he imposes on our neighboring countries are too stiff, it will cause prices of certain things to go up. And for example, if we're importing tons of lumber, let's just say from Canada and offshore, and I think we're a net producer of it, but just to say we import a whole bunch of materials for building houses, but they're all tariff. I mean, the price of houses are going to go up. If we buy all of our gas from Canada because we aren't energy independent for another year, well, and we impose a big tariff on that, well, the gas prices actually go up, not down, and maybe it doesn't solve the inflation problem for a year or two. So again, I think you have to kind of enter each phase with a new look. I don't think there's anything that I would say, oh, Trump's president, so let's just invest in this for the next 30 years. I think we have to be nimble. I've never seen a market more skittish, more unrelated to fundamentals than it is now. It's kind of got to follow the money and see what the smart money's doing. I mean, look at Warren Buffett. He's raising a bunch of cash. I think it's probably smart to take a very conservative approach. The stuff that he's buying, like Occidental Petroleum. Okay, well, Occidental, he thinks that's going to be a great stock. Why? Because I think he believes that Trump's going to make it a great stock. Maybe that's where we look at smart money. What are they doing? And smart money changes their mind. Sometimes they're buying tech heavy, and sometimes they're selling it off and buying energy or biotech or the Magnificent Seven. If you look at the Magnificent Seven, the one that's driving the S&P for the last several years, they've kind of stunk it up for the last few months. I mean, you look at the trend, it doesn't look that good for the Magnificent Seven. Does that mean they're always going to be bad? No, maybe it's a great time to buy them because they're down. Maybe we wait a little while and buy them again. So again, I don't think there's a perfect answer that I can give you is, next week when Trump's now the president, what are we going to buy? And we just have to kind of play it by ear as things materialize. But I want to wait till the market in general is at a much better place valuation-wise than it is today. I don't think just because Trump's president, he's going to make a $200 stock that should cost $50, a good buy. I think it's still probably going to be a $50 stock. Maybe it's worth 60 or 70 now because of Trump came in office. But I don't think he should overpay for stuff that's already overvalued. And that's what everybody's been doing for the last year or two, is just overpaying for things that are already so overvalued that history says they're not going to grow for the next 10 years.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about the Trump Presidency 2.0, which is about to take place in just about 2 days. If you have questions for Jeff about how the Trump presidency may affect you and your investment strategy, maybe you want to talk about your journey towards a confident retirement, we're offering a chance for you to sit down with Jeff on a one-on-one basis and get your questions answered. It is the Premier Retirement Planning and Wealth Management Roadmap. You can get yours, no cost, no obligation, by calling 520-780-9059. 520-780-9059. Make that call this weekend. Leave your name, telephone number. Shelley will call you back during the week and set up a time for you to talk with Jeff. Again, no cost, no obligation for this whatsoever. 520-780-9059. Make that call this weekend to set up your consultation with Jeff. No cost, no obligation. You can also find out more about us online at premret.com, premret.com. Jeff, most weeks we talk about a case of the week. What was your case this past week?
I have a lot of cases. Actually, my case last week was hunting in Mexico, so I didn't actually have
not much
any current cases. I did get a nice little coos deer. Actually, it was a nice symmetrical adult coos deer. It was really nice, and it was fun to go hunting down there. Practice my Spanish a little bit and eat some quesadillas and guacamole, so that was fun. The case of the week, I really want to talk about a case of the week that's kind of been developing over the last with some annual reviews, and it's not really a case of the week, and it's probably not as positive experience, but it basically reiterates the importance of a plan So I'm going to go back about 5 years ago, so actually almost 6 years ago, when a client came to me, late 60s, recently retired, came with about a $3 million estate. They hate paying taxes. They don't want to take risks. Bottom line is we repositioned their plan. They already had some annuities and things like that. I didn't particularly think that they were as awesome as, ones that, I could have got them had they met me before, because one of them you had to wait 10 years to take your income, and, it's kind of a fake bonus, and the actual growth wasn't really that high compared to others. But, we left it alone because, there's about a third of their estate was in it, and we didn't want to take a big penalty. It would have cost them a loss of some super high income bonus plus, more than a 10% penalty. So we left that in place and decided to basically take the penalty-free withdrawals and move those to something that would provide, instead of taxable income in the future, but would provide tax-free income. That's where I like to use the LURPs. Now, we also considered a Roth conversion. We did that with some other monies, but we were able to fund these LURPs that gave them approximately a $2 million death benefit, which essentially would be usable during your life. And that's why I think a life insurance retirement plan is what we call LURPs. And I've talked conceptually about it here on the radio. It's kind of hard if you don't see the numbers to understand how it works from start to finish. But basically, life insurance is like a Roth account on steroids. They call it the rich man's Roth because rich people use it all the time. If you were to convert an IRA money to a Roth, let's say you put $100,000 into a Roth, you need to pay $30,000 in taxes roughly in order to have that happen. Now, the first thing you don't want to do is deplete that Roth account and only have $70,000 in there working because you actually took the tax money out of the IRA money that you converted. You want to take that out of your bank money or excess earnings or something like that so that you have the entire $100,000 that you paid taxes on to work for you in a tax-free basis. But here's what happens. In a few years, you want that money. You take, let's say, half of it out. You take $50,000 out. Let's say it grew to $120,000 over the next few years, and you take half of it out. Let's say you take $60,000 out. You only have $60,000 left. Now, let's compare that with a LURP. So if you converted that IRA money, that $1 million in IRA money, took 10% of that out every year over the next 10 years, and put $100,000 in a LURP, in 2-3 years down the road, let's say that LURP's worth, you've put some money in there. Let's say that $100,000 is now worth $110,000 or $120,000, and you want to borrow $60,000 of it. You don't actually take the money out. You borrow $60,000 against that 120, or after a few years, actually after 10 years, it would be $1 million in there. So let's say that $1 million is now worth, $1.5 million, and you get to borrow from it. Let's say you want to borrow $500,000 and buy a motorhome, which I think is probably not a very wise investment, loses value a lot. But if you have that money to lose and you want to travel home in style, do it. But let's say you just want to pull that money out. You don't pull the money out. If it was a Roth worth $1 million, you'd actually use the money up. It would not be in there growing any further. In a LURP, that money stays in there, but you pay an interest rate that is more in line or even less to borrow that money against your future death benefit, which is tax-free, by the way, on life insurance. And the money stays in there growing and compounding with ever-increasing interest. And if it can grow, let's say 6% and compounds every year or every 12 years, you're going to double your money in a tax-free account. And whatever you want to use is tax-free. It doesn't. It's not like an IRA withdrawal where you have to pay taxes on it and have to pull out 1.5 times what you need in order to pay a third of it in taxes. Or it's not like a Roth where you have to deplete the asset and then you don't have it there anymore. You continue to have this asset working for you. So bottom line is we were going to do some conversions. And the whole idea was, if we can pay taxes on more of your IRA money over the next few years, and we were actually going to accelerate it. I use a 10-year plan, but I was going to accelerate it into 5 years because we had other funds that we were going to do to fund these LURPs. The client right away says, oh my gosh, it's going to increase my taxes. And within about 1 or 2 years decided not to withdraw it. He'd rather use other savings that didn't cause him a tax problem, but he really liked the idea that he could fund a LURP, fund the life insurance. I recommended against it. I said, that's not really how the plan goes. The plan is so much more tax efficient if you don't do that. Well, instead of paying $50,000 or $60,000 in taxes for the next, 5 or 6 years in order to go down to a tax bracket where he only pays $13,000 or $14,000 in taxes for the rest of his life, he decided to use up his other money. I said, I highly recommend against it. So the bottom line is, I would rather somebody be mad because they never lost money and had mediocre returns but are happy in retirement than lose half their money and say, gosh, Jeff, why did you risk all my money and I lost? Bottom line is, stick to the plan. They work. Then you have less regrets down the road.
Talking with Jeff Hogan of Premier Retirement Planning and Wealth Management. Once again, if anything has piqued your interest, call for your no-cost, no-obligation Premier Retirement Roadmap, 520-780-9059. Jeff, unfortunately, we've got to wrap it up for this segment. We're going to take a quick break. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Thank you so much for joining us each and every week for Premier Retirement right here on 790 KNST, Tucson's most stimulating talk. And of course, if you've missed any part of our program today, remember we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Once again, our telephone number 520-780-9059. If you'd like to talk to Jeff, get in and get your Premier Retirement Roadmap. Okay, time for listener questions. Jeff, our first question comes from Patricia listening to us in Tucson. Tricia writes, my late husband set up a lifetime annuity for me with a well-known company. I get a monthly deposit into my checking account. I called them for the value and they told me there was no value to this. I don't see how it could generate monthly income if there was no value to the account. I asked to see the original paperwork and they won't give it to me. What should I make of this and what should I do?
Well, if your husband has passed away, he probably got that a long, long time ago. The annuities work three phases. One, you fund it. Next, you let it defer until you need income, and then it turns income on. So I'm assuming you turn that income on either when he died or he may have already set it up with a lifetime annuity with you as a survivor benefit that you continue to get that money. Now, what a company will do is you can trade an account, let's say $100,000, give it to a company. Basically, you gave that money away and you bought yourself a pension of, let's say, $7,000 a year for the rest of your life. Now, it'll take you about 14, 15 years for you to get all your money back. But if you live 30, you get twice your money back. The company really has no value because they put it in their coffers in a big pool of funds in order to pay you that ongoing commitment or contract that you bought or that your husband bought for you for the rest of your life. So there really is no value because there's no commutable value. In other words, you can't cash it in on those traditional annuities. That's kind of an old school annuity where people do get frustrated, and it's very common that people ask questions like you're asking right now. It's like, what happened to the money? Well, what happens when I die? What if I didn't get the $100,000 back that my husband put in there so that I could have that extra $600-700 a month? Or, maybe $1 million in there so you can get $60,000 or $70,000 a year. What happens if I die early and we don't get our money back? Well, that's the chance you take. If you don't live long enough to get all your money back, your money stays in the pool and pays for those people that live too long. So it's basically a risk mitigation account for an insurance company, but it gives you the benefit of knowing that you'll never run out of money as long as you're waking up every day and breathing oxygen. So, it's not necessarily a bad thing. That's the way your Social Security works. That's the way your pension at work works. However, there's a lot of new annuities. And, I'm not necessarily going to say that you can go back in time and fix this. You can't. You're pretty much locked into a contract, but that's fine. If the listeners are wondering, well, what should I have done? What could you have done? And if you don't mind, I'll just answer, an option to that is most companies realize that there's a lot of pushback, especially from heirs that say, hey, wait, mom put this much money in that account and we only got half of it back before she died. Where did the rest of the money go? It left. So then they get all frustrated. They try to hire attorneys. The attorneys can't get anything because the contract said they don't owe you anything, and everybody gets frustrated. So companies have come up with a new plan where they call it an income rider. So instead of actually funding the annuity, let it defer, and then taking an annuitization or a lifetime payout from it, insurance companies say, you know what, if we just let this thing defer until they're 115 years old or longer than they're going to live, and just keep it in deferral mode. And in other words, let them have access to the principal should they need it. But since we know we can make at least 3 or 4% on this money in our world, we know we can make X amount, then we can afford to pay this client X amount for life, and we'll guarantee that income. Now, if the company underperforms and they run out of money, it's on them. In other words, there's not a situation in these cases where you don't at least get your money back, unless there's some sort of a fee schedule that could hurt the account. I typically steer away from those. But if there's a situation where no matter what, you're going to get all your money back, and if you live too long, you get more than your money back, and if the account performs better than expected, you either get an increase in income or there's money left over when you pass away to your heirs. So those are called income rider annuities, not annuities that annuitize. So it's all new, probably word game, but it's just that there are different definitions for the different types of payouts that you get. I like annuities that you don't have to annuitize because you lose control of the balance of that account. So there are what I call the cake and eat it too annuities, where you can purchase them, live on income, and still have access to the balance. I mean, let's say you go to a nursing home, and you're getting that, let's say you're getting $5,000 a month from this annuity, and you go to a nursing home and you need $10,000. But, you have only used half of the, $500,000 that you put in this annuity a while back. and there's still a chunk that you should be able to spend. Well, they're going to pay it to you over the remainder of your life. But if you only got a couple of years left to spend in a nursing home and you can't access the balance, that's really not, in my opinion, the best use of your funds. I like to have an account that you could at least, if there is money left, tap that money for whatever cause that you need it, especially if it's to help you in your well-being in your final years.
Patricia, thanks so much for listening to us in Tucson. Of course, we'll send you out Jeff's book, Retirement, the Road Ahead. And again, if you'd like to get in, sit down and talk with Jeff about your individual situation, our phone number, 520-780-9059. Make that call this weekend. Next question, Jeff, is Gary in Rancho Vistosa. Gary says, although everyone is different as far as their situation goes, at what tax bracket does it make sense to start converting your 401k into a Roth 401k and pay the taxes up front? For example, I'm 42 and my wife and I have a combined income of $560,000, putting us in the 35% federal tax bracket. We have $2.5 million in traditional 401k, 403b accounts. Assuming we both retire at 67, does it make sense to start converting into Roth accounts and take the tax hit in the next 5 to 10 years compared to 25 years from now?
Well, that's an interesting question. I think it's always important to try to pay tax at the lowest rate possible. And right now you're in a 35% bracket because the Trump tax cuts made that the max tax rate. If you want to, wait until that sunsets and goes away, you'll probably be in a 40 plus tax bracket, and there's no telling how much higher the tax brackets are going to go in the future. Now, you have to decide if $560,000, is that still the range of income that you'll make in retirement 20 years from now? I mean, it looks like you've got about 25 years from now. In just real easy numbers, if all you average is 5 or 6% on the growth of that 401k and you don't put any more in, you're probably going to have somewhere around $10 million in 401k, 403b accounts. That's going to mean you're going to have to be forced to take, at least when you get to retirement age at age 70 plus, that amount would require you to still live on a $400,000 or $500,000 a year income, plus Social Security, plus other investments, plus the extra, probably, $1 million that you put into your 401k that grows to another 2 or 3. You might have $1.5 million in 401k money. That's all taxable. I think from this point forward, at least, you should probably, be happy with a 35% tax bracket, especially if you have money outside of the 401ks, or if you have, of the 560 combined income, let's say you're living on 250, you're paying, let's say, 150 in taxes. What do you have left? Maybe you have $150,000 left. If you paid that at 35% to the tax man, that means you could roll about $600,000 a year over into Roth, which would give you about, during Trump's presidency, you could probably roll all of it over to a Roth. I don't think that's a bad idea, honestly, at this point, because at your situation, I don't see you getting into a lower than a max tax bracket. I mean, I have a lot of clients that are like that, high income, high net worth. They're able to save a lot. They're going to always be in the top tax bracket. I think the top tax bracket in the future will be higher than 35%. Now, if I met you and you were 59 years old, you had, let's say, $1 million in your traditional IRA, and you're making $560 for the next 5 years, but hoped that $1 million would turn into $2 million, and you were in a 35% tax bracket now, and we could project that as soon as you retire in 5 years, you'd have $2 million in 401k money, and you would be in a, based on your retirement, paychecks, you'd be in a 12% tax bracket or a 15% tax bracket. And, if we pulled an extra $150,000 to $200,000 of your 401k out over the next, let's say pull $200,000 out of your 401k for the next 10 years, and you could stay in a 28% tax bracket, I think that would be a smarter move to pay 28%, over the next 10 years after you retire in 5 years than it would be to keep getting a 35% tax deduction and just being a 40 or 50% tax bracket by the time you get to retirement. So in your case, I would say you're probably good. I mean, obviously we want to make some additional projections. Do you plan to work 25 more years, or just plan to work 10 years and then sit it out until you're at retirement age? I mean, honestly, at the 560 range, if you're spending all of it, maybe you don't have the money to pay in taxes. You're having too much fun now, and maybe down the road, you're not going to add any money to the 401k. But I see you in a worse tax situation in the future than I see you in right now, to be honest with you, even though you're at the highest tax bracket. So I think converting to a Roth, or even better, check the LERP out. So the bottom line is pay taxes on that conversion while you're in the lowest tax bracket possible. And you might have to do some projection to decide what that is. But bottom line is pay the least taxes you can when you have the least amount of money in the account, rather than pay taxes at a higher tax bracket when there's more money in that account.
Gary, thanks for listening to us in Rancho Vistoso. Again, you'd like to get in and sit down and talk with Jeff, 520-780-9059. We'll send you out Jeff's book, Retirement, the Road Ahead. Next question is Charlie, listening to us in Catalina Foothills. Charlie says, my wife and I are both 62, have recently retired, and we're blessed to have a resilient plan in place with assets over $10 million. Now that I have some spare time, I've started looking at optimizing our plan relative to taxes and estate planning. Like many baby boomers, we have a lot of money in pre-tax assets, about $3.5 million. That'll lead to some large required minimum distributions in the future and to large tax burdens on our 2 children and 7 grandchildren. Due to some deferred compensation I receive in the next 5 years, I don't see our tax rate dropping below 32%. We have a donor-advised fund that'll meet all of our charitable plans for the future. My question is that given our tax rates, should we be doing Roth conversions or just wait until we start taking RMDs? My main concern is that I really would like to avoid leaving a big tax bill to the family, but also cringe in April at tax time.
Yeah, well, like some Americans, you've worked really hard and you've gotten to a high tax bracket. Congratulations. You've made a lot of money, saved a lot of money, and now you get to pay your share, your fair share, right? I think I'd say that tongue in cheek, but it's probably more than your fair share. I hate the tax man, too, not because I don't think it's good for me to pay my share of the tax burden of America, because I think they do a lot of good with our tax money. But the majority of it goes to places that I don't agree with. So I don't like what they do with the majority. With some of my tax money, it's okay. But yeah, I think we overpay, and I would rather redirect my surplus funds to charities and do other things. Now, you have a donor advised fund. I don't know if that's included in that $10 million or if that's some fund that you just funded one time, or you're going to continue to keep putting money into it. One thing you can do in the future, is you can give direct charitable contributions from your IRAs straight to a charity, and they're, going to be a tax deduction because they're given directly to a charity, and they do also count for your required minimum distributions. Now, your question is interesting because it really follows in line with what Gary's question was right before you, and that is, he's 42 years old, and, had he been 59 or 62 like you are, having access to 401 and 403b accounts, I would say, rather than a Roth conversion, why don't you look at a LIRP? Life insurance retirement plans are really cool. Let's just say you put that $3.5 million over the next, let's just say 7 years, because that's $500,000 a year. Let's say over the next 7 years, every $5,000 that you have to take out of that 401k or IRA qualified money is going to be taxed maybe at $150,000 a year. So for that period of time, hopefully you have, of the other $10 million in assets, you have access to some that maybe after tax money that you could, pay those taxes off and be done. That $3.5 million would likely cover you and your wife for a total of maybe $10 million in tax-free death benefit to your children over the next few decades. Or if you want to do something even more fun, is you could use that for a tax-free bank account and borrow against that, let's say $5 to $10 million in future death benefit, which is tax-free, and still keep that $3.5 million growing on a tax-free compounded annual basis. And if you want to borrow any of that money, you borrow at a rate that is typically at or lower than the rate of return that you compound on your asset. For example, if you had $3.5 million in a LIRP, life insurance retirement account, and did indexed universal life like we use, last year, all of our clients that were in a market-related allocation made somewhere between 8 and 20% returns on an account that had principal protection on the cash value. Had the market gone down, they wouldn't have made any money on the cash value. But let's just say you had $3.5 million, you made 10%, that's $350,000 in interest. Now, in order, the cost of doing business, just like a mutual fund has a cost, let's just say the cost is 1%. So it costs you $35,000, less than most advisors would charge, or in the same ballpark as total fees would be. So you have this tax-free access to this cash that grows at a net of, $320,000 roughly. And let's say you want to borrow $1 million of it to, build a cabin in the mountains. So rather than go to a bank, you just borrow it from yourself. Well, that money stays in that LIRP and continues to grow at like 6-ish%, let's say 10% on good years, 0% on bad years, and 6 or 7 on average. But you borrow that money at roughly 5%. So let's say you borrow $1 million at 5%. So now you have a $50,000 a year interest charge on that $1 million. But you're making $3.5 million, or let's just say 6% on average of $3.5 million. There's twice that in interest that you're making on the, more than twice that in net interest that you're making on your cash value. And that cash value continues to accumulate, compound, and grow and grow and grow. Eventually, it actually makes the death benefit, or what you leave your heirs, even more than that $5 or $10 million. So many clients that have either a big asset that they're selling a real estate property and they're upset about the 20% tax hit that they're going to take on a little apartment building or a strip mall. Well, you can turn that back into something worth more than that strip mall was as a tax-free death benefit, live on it, use it, not have it affect your tax returns at all because you never get a 1099 on it, but you still have access to those dollars. So my opinion was rather than do a Roth conversion or consider that, and I think it's one option. And for Gary, the last question, he's 42 and he really doesn't have the option to. Otherwise, he gets not only taxed, but he gets penalized at a higher rate on that 401k withdrawal if he were to do a Roth. So I think the Roth conversion, or you do a LERP, Roth conversion is best for him. But for you over 59 and a half, where you have access to your 401k and IRA money penalty free, in my opinion, it's a no-brainer if you're healthy enough to get life insurance. So explore that. You get more income, you have more access. You probably leave your kids more on a tax-free basis. If you don't want to leave them a burden when it comes to taxes, you'll really love what a LERP will do, a life insurance retirement plan will do. The other thing you might want to consider with that is a life insurance trust where that asset does not belong to you technically when you die, so it doesn't get estate tax. That's another big problem with large estates is as they get larger and larger, the government wants to split the difference with you and take part of it, even up to half of it in some cases, in order to, basically reapportion your wealth to those people that didn't work as hard and didn't save as well as you did. So if you want to keep it all in the family, consider a good estate plan with trusts, with some asset protection measures, and with some tax-free income and tax-free death benefits.
Charlie, thanks for listening to us here in Catalina Foothills. And, of course, the phone line is open for you to talk to Jeff. 520-780-9059 is our telephone number. Get in, sit down with Jeff and ask these questions of Jeff. Have a private consultation. It's not going to cost you a dime. Same goes with anybody else listening to the program today. If you've got questions similar to the ones that we have answered on the air today, you'd like to maybe sit down with Jeff and talk about them in person in a private situation, just a casual conversation, actually. Call this number, request your no cost, no obligation, no judgment retirement roadmap. Again, it's 520-780-9059. Write that number down or call it right now as you're thinking about it. 520-780-9059. Leave your name and telephone number. That's all you've got to do. Monica or Shelley will probably call you back during the week and set up that appointment for you. Again, it's 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, we intended to talk about a number of things here in the program, but of course time is running a little bit short. We'll talk about some ways to generate income in retirement in a future show. But before we go today, I want to revisit our Premier Retirement Roadmap, what that process is all about. When people call 520-780-9059, what can they expect?
Well, some people come with kind of a budget in mind. They say, this is what I need and how can I make my money, achieve that? And some people say, I don't even know how much I can spend. And so depending on the goals or, where you are in that planning process, sometimes it's easy for me to just say, okay, if you take a conservative approach and, do everything you can not to lose money and make a reasonable rate of return and get some guaranteed income sources in here, we can get your income to X. Now, how do we do that? Because it's a retirement plan really is about replacing the income that you had from work with income that you have from your investments and other sources, especially when the majority of people retiring today don't have pensions like in the olden days, as my kids call them, the olden days. My grandparents, they all had pensions, and my dad had a small pension, but they're kind of a thing of the past unless you work for the government or in the school system. So the approach is basically five pillars of planning. We've got your investments, income, taxes, long-term care, health care, and then the estate plan. What happens to your stuff when you're gone. So the first thing we have to do is either determine what income you need, or we can even do it kind of reverse engineer it by saying, okay, this is what you have. If we do what a typical happy client at Premier does and puts, maybe a third of their money into something that guarantees income, we add that to your Social Security. Maybe that gets you up to $75,000, $80,000 a year, let's just say. Then you have a few assets that you want to use in a tax-free account where you can just grab money anytime you have that, surprise expense that, may come up in the future. And do it on a tax-free basis, or even create a tax-free income stream through LERPs or Roth IRA conversions. If you do have to be healthy to, somewhat healthy. You don't have to be perfectly healthy, but pretty healthy to qualify for a LERP because it is based on a life insurance chassis. Now, if you want to do the Roth conversion because the LERP doesn't work, we can also look at guaranteed income opportunities. But the investments have to support the income. You have to make sure you're not risking that income by having too aggressive investments. Now, once that's said and done, hey, what tax bracket are we in? Maybe we're up in $150,000 income minus the standard deductions. You're still at about $120,000, but you want to be maybe in the 80-90 range so you can be in the 15% tax bracket. Well, that says, okay, well, how much do we have to move over the next few years in order to create that extra $30,000 or $40,000 in income that you want to receive in retirement as a tax-free income? Either through Roth, maybe even a Roth income annuity or a LERP, and have some income coming from that would make up that difference. But we want to make sure that your taxes are minimized, that you maximize all the withdrawals at the lowest tax bracket you can, and then whatever you have over and above that tax bracket, if we can make it tax-free income, especially stealth tax-free income, not just Roth income that's tax-free, but stealth, meaning they don't even issue a 1099 on LERP income, then you might find yourself in a position where you have all your income needs met at a good tax favorable basis. And then you have maybe a 30-year assets or in a managed account, whether it be IRA, Roth, or an individual account where, you get to pick and choose sectors that you want to invest in. You get to pick and choose the risk that you want to take because it's money maybe you can afford to lose or wait on. Maybe you don't want to lose or wait on. Maybe you still like to be conservative even on the managed stuff, and that's fine. I think in where we're at right now with the market as overvalued as it is, it might be okay to take a more cautious approach. Most of our clients are with their money. That's why they come here, because they know that we're more of an asset protection focused firm and a tax planning and income planning firm rather than a growth firm. That's what you should do when you're in your 40s or 50s. And honestly, I'm scared to risk other people's money to the extent that I feel it's going to create worry in their minds. Now, some people are really good at explaining because of their situation that they have plenty of tolerance for risk, and that's fine. Then I won't lose sleep over doing that. But I think sometimes people, just because they have friends that made a lot of money in the stock market, thinks that they're risk tolerant until the market starts hiccuping, and then they also find out that they're not. So as you get older in retirement, then what about long-term care? That's one of the second, healthcare is the second biggest expense for most of our clients behind taxes. Do you have a long-term care plan? Do you have enough money to fund it? Do you have access? One of the things about a LERP is that you can access the tax-free death benefit to actually pay for long-term care or those final expenses before you pass away if you want to. You don't have to die to collect death insurance or life insurance. I think life insurance would be money that you can use while you're alive, and that's why I call it life insurance, and I call it life insurance retirement plans. Then the final deal is, do you have a trust? Do you have a will? Do you have some process to distribute those assets when you're gone? Let them go to who you want, how you want, with the least amount of trouble, taxes, and avoid probate if you can. That's pretty much the basics of the 5-step plan, and that's our process.
And if you would like to take advantage of the opportunity to get this 5-step plan with Jeff, get the conversation started, you can do that by calling 520-780-9059. Do it right now while you're thinking about it. All you got to do is leave your name, telephone number. Shelley will call you back during the week and set up that appointment for you. Once again, 520-780-9059. No cost to this. Absolutely no obligation whatsoever. We're not going to try to sell you anything, and certainly there is no judgment. So take advantage of this opportunity right now to get your premier retirement roadmap at no cost, entirely complimentary. Once again, that telephone number, 520-780-9059. You can also find out more about us online and request your roadmap at premret.com, premret.com. Jeff, out of time for this week. Thank you so much for your time. But most importantly, as always, each and every week, I want to thank our listeners for joining us here in the greater Tucson area. So for Jeff Hogan, I'm Jeff Shade. Have yourself a great weekend. We'll talk to you again next week with another edition of Premier Retirement here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.
Hi, this is Jeff Vogan, founder and CEO of Premier Retirement Planning and Wealth Management. We're in the financial planning business so you can be in the let's have fun and not worry about your retirement business. It makes no difference to us whether you want to hang out with the grandkids, go back to school, start a new career or hobby, or spend your retirement partying in the Caribbean. These are your choices. Our mission is to help you protect your life's work and turn it into a predictable income plan to finance the things that make you happy. Premier's investment philosophy is simple. Protect and manage your savings. Create strategies that seek not only to provide an income stream you can count on, but to grow your principal to keep up with your lifestyle. Retirement the way you want it. Finding the right partner that really understands you and your goals could truly shape your life for the next 30 years or more. So call us at Premier Retirement Planning and Wealth Management for a complimentary, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or visit us online at premret.com. That's PREMRET.com.
Investment advisory services offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.